This week, we're talking SPACs or IPOs as Case Studies with the Biz Docs makes our way to Hawaii. And the favorite drink of Hawaii is the Mai Tai. That is refreshing, but you shouldn't drink and drive. And while I'm walking the beach, the only thing I'm driving is my feet. This week, let's talk about what's driving market values, which is SPACs or IPOs, driving the value of companies that choose to go public via one or the other. I want to talk about two companies. First, this one, Root, that claims to use AI and a little gadget that they plug into your car to track your driving habits to determine the rate they charge for auto insurance. The second company is this one, MetroMile. And MetroMile asks you to pay by the mile and uses statistics such as what zip code do you live in, what's your past driving history, what kind of car do you drive, does that particular model have a habit of getting stolen on a national basis? You know, some regular statistics they have about your city, the neighborhood you live, whether you have a garage, normal stuff, but then MetroMile charges you just by the mile, whereas Root wants to know about your driving patterns. So these are two companies that are in what we call InsurTech. Now, what's InsurTech? That's insurance technology or new companies that are doing interesting things in insurance, building the companies of tomorrow, and testing out things that maybe current insurance companies aren't testing, such as, what if we charged them by the mile? MetroMile. Such as, well, what if we just put the full-time gadget in their car or some sort of device and let's just track how they drive at all times? Root. Well, both of them were early stage companies that grew up with some venture investment and then went to the stock market. Let's dive in. I'd like to start with MetroMile. MetroMile went public using a SPAC, and they went public just a couple days ago. It was on, I think it was on February 10th or thereabouts that they went public. And it was JP Morgan and Company was an advisor, Cooley was their general counsel, and you need an advisor, an investment bank, and you also need a general counsel to take you public. So these two companies took them public. Let's take a look at the stock chart. Hasn't been out there very long, as you can see here, and they raised $400 million for the company. What that means is $400 million came to the company as a result of going public, and MetroMile chose a SPAC. Now, what a SPAC is, you can go look that up, and I'm not going to talk too much about that other than to say is that an organization, a banker, puts together the SPAC with the money and it sits on the stock market at $10 a share, but it doesn't go up or down. Why? Because there's no company there. It's just $10 a share for effectively a holding tank with money in it. Well, they merged with the company and MetroMile had JP Morgan help them and went and merged with them. That put them on the stock market and they received $400 million to go do other things and build up MetroMile. And here we go. Well, let's take a look at what has happened in the short time since they've been on the market. This chart shows that they started out at $9.75. There's that $10 number I'm talking about, with a valuation of about $1.23 billion. In other words, on day one, they were worth about $1.25 billion. Now, MetroMile has got real business, real customers, and real metrics to go track so that you, me, and all the analysts that are going to be saying, I have a buy rating, I have a neutral rating, I have a down rating, sell rating, whatever it is, they can track them. In other words, the whole ecosystem of being a public company is in play. As we look back at the chart, you can see in just a couple weeks here, they've traded up to $17. That is the IPO pop. Now they have a valuation of the vicinity of $2.2 billion. Now, you don't really want to see more than that. You want to see steady growth from this point forward as a result of real value for the company. Selling more policies to more customers, proving it works, and moving forward as a sustained company with a great board and everything moving forward. That, my friends, is MetroMile. I think they're off to a decent start. Time will tell where it goes, but there's an example of number one, MetroMile, that has gone public through a SPAC with high quality advisors like Cooley and JP Morgan, and they've gone from 1.2 to $2 billion in value. That's up about 70%. However, in market terms, it's only $10 to $17. Sometimes that doesn't seem as much as saying, hey, I'm going to raise more venture capital money and I'd like to go from $1 billion to $2 billion of valuation. The market is a different thing. It's a living, breathing thing that thinks forward in valuation. There's a lot of forward pricing put into most companies. Take a look at Tesla. You don't think there's forward pricing put into that about where they think they're going to go with energy, roofs, cars, things like that? Go look at a case study you did a couple weeks ago and I'll tell you, all those things are priced moving forward. And in MetroMile's case, I would not like to see them go much above the 16, 17 until they have some sequential earnings reports. That shows that MetroMile made a great decision, went public, is giving you and me as investors the opportunity to buy into their opportunity, which they're out there saying, I'm going to charge by the mile. I think that's a great way to sell car insurance, and we're going to see if I can build a great sustained company moving forward. MetroMile. I kind of like where they are, and that is an example of going public with a SPAC. It didn't take them 18 months to do. They got together with a SPAC company, they merged into that company, and away they go. Maybe on another case study, I'll take you through the A, B, C, D steps of how a SPAC is built. But for right now, I imagine most of you have read those little articles online. Money Watch is a great place. The Motley Fool is a great place where you can read about all those. I wanted to stick with just with MetroMile and where they were going and getting out. I don't want to get a bunch of hate mail for that comment, but I think you understand what I mean. Root went public through a traditional IPO path. Let's take a look. Root, as I said before, they sell car insurance to people, and they use your real driving habits that they track with a device or some other means to see how your real driving habits, regardless of how much or how far you drive, line up with the rate that you should be paying. Let's take a look at this chart. This shows that they went public on 10/27/2020. And they raised almost $750 million. That's right, a little tiny car insurance company goes out on the stock market, and with a regular IPO that took them like 14 to 18 months to pull it off, and Sarbanes-Oxley and all these things that they had to do to get there. But the reward for that is this little company suddenly gains $750 million, $750 million on day one. Only word for that is damn! When you take an IPO out, you can sure make a lot of money. Well, in this case, Root did, but let's see what's happened since then. Back to the stock chart. 10/27, they were at $23.97. That's a pretty big pop out, and they were allegedly worth at that time market cap about $7 billion. Today, however, an earnings report has come out, little announcements have come out. They're trading at $16.50, give or take, here at the end of February as we look from beautiful Hawaii at the New York Stock Exchange, which is way over there. And we see their valuation today, as we stare at the chart here, is about $4.1 billion, $4.2 billion. So what's going on here? One company goes out with a SPAC, one company goes out with an IPO. Both companies are in the car insurance space. They're labeled insurance tech, using new methods or technologies to sell car insurance to you and me. But there's a dramatic difference in their fortunes when they go out. Now, what has driven the stock price? Performance. Root's stock price has been driven by the performance and the assumptions of the future fortunes of the company, not because they're an IPO or a SPAC. Root did a very good job. Hear me clearly. They legally, ethically went out, set up the IPO, spent all that time and effort to get Sarbanes-Oxley clearance, to put their S1, work with a banker, work with corporate counsel, get a public board, and work with analysts who are going to follow them. But they went out, pop up to that big number, looking back at the chart again, but today, not very many months since October of 2020, they're back down here. So what's the moral of the story? What is the lesson of this? The lesson is not that SPACs are good or bad, or that an IPO is good or bad. It's this: a SPAC will take you less time and energy to get out. An IPO will take you more time and energy to get out. But once you're out, you need to be at least $500 million to $1 billion in valuation, rule one, so that all the following analysts will track your stock. Meaning you'll have a set of analysts that say, buy, hold, accumulate, sell, get the hell out of town. You know, all those ratings that they will give you. There's not a get the hell out of town, but by the way, I think there should be. You know, we should update the stock rating system for just that purpose. So the point is, you can go out ways, but what do you have to have? You have to have a great company with a great product that can carry forward and visualizes itself not 1, not 2, not 3, not 4 quarters, but 8 to 12 quarters forward. Visualize your forecast and say, I believe in what we're doing, I believe in the products we're going to come out, the next version of our software, all the things we're going to do, or in the case of MetroMile and Root, how you're going to accumulate new customers for car insurance using your new fintech strategy to get there. So this Has nothing to do with SPAC or IPO. It has to do that in these early days, the market thinks MetroMile may be onto something. The market thinks Root maybe needs to drop down a little bit and prove something. That's all it means. It doesn't mean Root is bad. It means Root has come down, investor confidence is down, and they have an opportunity to prove into the future that they're worth a higher valuation driven by a higher stock price. MetroMile, early days, people like it. Now let me talk about a little difference here. MetroMile not only uses its own system to sell car insurance to you and me. If you're interested, they are also licensing the software. That's a big deal. Let me explain it. Once upon a time, Amazon built what would become AWS to power its own products and its own needs, because you couldn't go down the corner and say, hey, I'm going to take the Amazon bookstore, I'm going to turn it into frickin' everything store, and I need 22 gazillion gigabytes of storage space to go do that. Well, it didn't exist. They were able to do some of it, but as they grew over time, they just built it themselves. There were systems out there they could use. There were companies out there that wanted to help them and wanted to move forward. Giant IT companies, Google, Oracle. In the end of the day, Amazon said, nope, we're going to build AWS ourselves for our own purposes. And now today, they sell AWS services to all of us. And by the way, the head of AWS, Andy, is about to become the CEO of Amazon. So AWS became pretty big. MetroMile is doing something similar on a very early stage. They've built their own software platform to do all this calibrations and calculations and things to sell a new fintech-based car insurance to you and me. And they're actually selling that engine, that software, to other companies to do it similarly. So guess what? I see MetroMile as a little baby Amazon, but they're not waiting. They're coming out on day one saying MetroMile product, and then MetroMile Enterprises, I believe it's called, where we will sell software. Root is just using this methodology to go sell car insurance. So there it is. I wanted to use a comparison this week to kind of show you a little difference between IPOs and SPACs, and also to draw a difference between two companies with different approaches. What the market thinks is about future valuation, and that's what it's all about. If you don't have a great company that could drive great valuation forward for about 12 quarters, you shouldn't be going public in any way whatsoever. Whether it's a SPAC or an IPO, or you have a slightly larger public company maybe buy you, and you're a key important division of that and driving the value of that public company. There's a few ways to get public, but if you don't have a great company with great business customers, B2B, great consumer customers, B2C, and you can't see 3 years forward, about 12 quarters or so, to say, hey, we're going to show value to the market, then you shouldn't be public in the first place. You're heading for a swan dive to the street. So that's what I think, but what do you think? Leave a comment below. Please subscribe to Valuetainment Economics and hit the bell, which lets us tell you whenever we've got new content here. If you really like this case study, check out this one. It's more great case study content from yours truly, the Biz Doc. And as I like to say, I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.